Good afternoon, everybody. Thank you for joining us. Today, we are going to talk about, I'm Shawn Britt. I am the guest speaker. It'd be nice if you knew who you were talking to, wouldn't it? So I'm Shawn Britt from Nationwide. I'm your guest speaker today, and I'm from Nationwide. I am part of the Advanced Consulting Group, also known in a lot of insurance companies as Advanced Sales. My specialty is long-term care and anything that has to do with how you could use long-term care, whether it in alternative ways, using it as business owners wanting to provide incentives for their employees or just take advantage of tax advantages for themselves. So we're going to go through today how CareMatters 2 can provide tax incentives that are going to be attractive to your business owners. And I'm just going to go ahead and go through. We have an echo in the room here. Hang on. We have a big agenda here today. I'm not going to go through this. You can read it quickly on the screen. And I want to start with what makes long-term care riders deductible, because long-term care riders on life insurance, such as if you were to buy a guaranteed UL or a VUL with a long-term care rider, it's not going to be tax deductible. The reason the rider isn't tax deductible is because all of those products are built the traditional way, where all the money goes into cash value. So you see the chart on the left, all the money goes into cash value. And then from there, cost of insurance is taken out of the cash value to pay for the riders. So the original Your Life CareMatters that we sold in California years ago, that one isn't deductible. Well, we wanted to change that. We knew deductions are important to people, particularly business owners. So when we redesigned the product and came out with CareMatters 2, which you finally have in California, we made sure that the long-term care premiums were deductible. And the way we did that is to, instead of using a cost of insurance, the LTC rider, which pays for the first 2 years of LTC benefits in CareMatters, then the extension of benefit riders, which creates the second bucket of benefits, and the inflation rider are now actually paid for with premium dollars, not cost of insurance. So none of the long-term care premium dollars have ever touched cash value. As such, we comply with the Pension Protection Act, and they are deductible. So not all companies are deductible. So some linked benefit policies, as these are known, are deductible, some are not. But basically, no LTC riders like IUL or VUL are deductible. So hopefully that helps you understand, if your client wants a deductible premium, you need to go with CareMatters 2. Now, your business owners are always looking for deductions, and we are coming upon that time of year where in the fall, I know our department in advanced sales, we get a lot of phone calls. Hey, I've got this client. He's a business owner. He's looking for a tax deduction. What do you have? Well, now we have something new, long-term care. And as you know, a lot of these business owners, they might not have been interested in long-term care before, but when all of a sudden they can get a tax deduction for doing long-term care planning, they become much more interested. And most business owners are owners of pass-through entities, meaning an S corporation, or they're sole proprietors, or they're part of a partnership. And what they're looking for are above the line deductions that come straight off of gross income without having to itemize or be subject to some kind of a floor. So with long-term care premium, it comes right off of gross income as self-employed health insurance. Now this slide, it's when someone gives me 5 minutes to explain this, but I still like to use it because it gives you the difference between the most valuable deduction and valuable but not as valuable deductions. So the best one of all is if a business purchases a policy for the C Corp owner themselves, or any business entity that purchases a policy for an employee. In that case, 100% of the LTC premiums are deductible. Everybody loves to hear that. Now, more valuable, not quite as valuable as the C Corp owner, but for pass-through entities, again, if they're buying it for an employee, they get the good rules, 100% deductible. But if a pass-through entity buys it for themselves or their spouse, then they are going to be able to take a self-employment health insurance deduction, but it will be subject to age-based limits. It's above the line, but they can't necessarily take all the premium. It'll be the lesser of the premium they paid or their age-based limit. Now, also valuable, but hard to get is the individual tax deduction. So I don't know how many, I wish you were all here in the audience because I would ask you, how many of you do your own taxes? I'm going to raise my hand because I do. And what do I use? TurboTax. So anyone who uses TurboTax, when you start typing in the deductions, what are you watching for? You're watching for that dial to go down. Every year, I have three long-term care policies. One of them is deductible. Every year, I plug that policy in and I wait for the dial to go down. And every year, nothing happens. Nothing. Why is that? Well, because in order for me to get that deduction, I have to be able to itemize. Well, it's a high bar to itemize now. And even if I could itemize, which once in a while happens, not often, I still have to have 7.5% of out-of-pocket medical expenses before anything is deductible. Well, I'm a healthy person. I don't have anywhere close to that. So the dial never moves. But what I do have is an HSA account. So my one policy that is deductible, it means it's also qualified for an HSA distribution. So what I do is I can, and now my premium is less than my age-based limit. So I may call the HSA administrator and ask for a distribution to pay for my LTC policy premium. Why do I have HSA as last? It sounds like it's more valuable. Well, that's why I have it last. You don't want to touch, you always try for the tax deduction. One year, my husband had a lot of medical problems. We actually were able to itemize and had met the 7.5% floor, and I got a deduction for my policy. That was the one and only time. So I didn't want to touch my HSA dollar. You want to save your HSA dollars for later use. So it's not that they're less valuable, it's they're the last one you want to touch if you don't need to. That's the reason I put it last. So at this point, from this point on, I'm just going to focus on the business owners. Now this, I love this slide because it's so fun, because there's so much good news on it. If we were looking at CareMatters 2, whether it's for C Corp owner who also works for the company, or any business entity wanting to buy a policy as a retain, recruit, whatever situation, this is how it would work. So the business sends the premium to Nationwide. Nationwide issues the policy to who that employee is. So it's employee owned. Now the life insurance premiums are going to be treated as a compensation bonus. That means it's like a 162 plan, except there's more to it than that. So the life insurance component of this will be deductible to the business as a business expense of paid compensation, paying wages. It will also be taxable to the employee as a compensation, a wage, a bonus that they have received. But here's the really good news. The LTC premium is treated as accident and health insurance. What that means is the LTC premium will be 100% tax deductible to the business with no age-based limit. And it is totally excluded from the employee's income, so it's not taxed. And finally, unbelievable but true, the LTC benefit will be tax-free. So this is just a fabulous story. And you can include the spouse. It says here spouse and dependents. What a dependent, I've not had a case yet where we've had a dependent. What a dependent means, because remember with CareMatters, you have to be at least 30. So hopefully by 30, the kids are out of the house, out of the basement, and that type of thing. But what you might have is a mother-in-law who's moved in with you. You may not be happy about that, but mother-in-law has moved in. She doesn't have a lot of income. You are Primary support, you're paying more than half of her support, which makes her a tax deduction. If she is a tax deduction, she is considered dependent for the purposes of long-term care, and you could actually throw her in on this. Now, I have not had one yet, but it is, I know she's come. That mother-in-law's coming one day. So anyway, you can include them too. Now with this, it's just like an executive bonus where there can be no ownership rights or beneficial rights to the employer. This is truly an employee-owned policy, and the owner has to be a bona fide employee. So what I mean, if you have a silent partner who invests in your company but does not work at the company, they cannot be included. Now, what about pass-through entities? That's what the majority of your business owners are going to be. So they're going to be a more than 2% owner in an S corporation. Could be a partnership or an LLC paying taxes, a partnership or a sole proprietor. Now, one thing I want to mention before I forget, because we're in California, we are in the land of farmers and ranchers. Not all states have a lot of farmers and ranchers, but you do out here. And farmers and ranchers are often constructed as an LLC, but they may choose to pay tax as a C corporation. That happens with the farmers and ranchers with LLCs. So when you have an LLC business, ask them, how do you pay your taxes? Do you pay as a pass-through or do you pay as a C corporation? If they say I pay as a C corporation, they get those rules. The owner will. So it's always a good question to ask. In most cases, it's going to be a pass-through, but it's always worth asking. Now, this chart is a common chart you see out there, though I like to put all the years in. I've got room for 2025, then I'm going to have to start deleting some years. But what I want you to, reason I put all these years in is I want you to see over time, the amount you can deduct grows, even if you're in the same age bracket. Your deduction usually will go up year to year. Once in a while, there's a hiccup, but over time, it will go up. And this is the age-based limit chart. So what this basically means for a self-employed individual who can also include their spouse, they're going to get an above-the-line deduction. It will be subject to the age-based limits, but you do not have to itemize, and you do not have to have 7.5% of out-of-pocket medical expenses. So it's a straight above-the-line deduction with no strings attached. And again, you can include your spouse and dependents. Generally, it's real. I get called in on cases, and a lot of times the business owner's around 57, 58 years old. So if you look at the chart here for this year, that would mean a $760 limit on their deduction. So if their LTC premiums are $3,000, they could only deduct $760. But if their LTC premiums were $1,600, then they could deduct $1,600. So it's the lesser of the LTC premium you pay or the age-based limit. One thing I want you to do when you're talking to the business owner and they tell you they're 60 years old or 50 years old or 70 years old, if they're right on the cusp of changing age, ask them when their birthday is. And the reason is I had a case in 2023 last year. It was October. I was running through this with the advisor, and the client was 60 years old. Now look at the difference between 51 to 60 and 61 to 70. That's a huge jump. This client's premium was going to be about $4,500, the LTC portion of his policy, $4,500, because he put inflation on it. And I said to the advisor, I know it's October, but when is your client's birthday? And he said, December 31st. And I go, so you're telling me on December 31st, he will turn 61. And he said, that's right. And I go, well, then forget the $1,790. Your client's going to get to deduct the whole $4,500 because you only need to be 61 one day of the year. Well, the advisor was thrilled, and I found out later, so was the client. That pretty much clinched the deal. So remember, if your client's just in that new age bracket, one day of the year, he gets the better deal on the age-based limit. So again, your deduction, if you're subject to age-based limits, will be the lesser of in your age bracket, the premium you pay, or the age-based limit. So what are the advantages? Well, there's advantages and considerations when you're using CareMatters 2 through the business. One thing, before I forget to mention this, we have a wholesaler who used to sell disability insurance, and they had a motto in amongst their wholesalers, and we've kind of adopted it over at Nationwide. But here's what it is. Presenting long-term care to business owners is like selling bananas. The cases come in bunches. So what do I mean by that? So literally, we have this happen over and over again. So the advisor goes in and he talks to his client, who is a business owner. And then he tells the business owner, oh, great, yeah, I want a deduction. And then he's like, you know, can I include my wife? Oh, yes, you can include the wife on this. Okay, great. We've got 2 apps now. Then he says, do you have any partners? Yeah, I have 3 partners. Do you think they'd let me come into your office and present this to them? Yeah, they'd like a business deduction too. So he goes in and he presents to the 3 other partners. And that one touch with that one client who is a business owner turns into 8 applications. And that's what that means. The cases come in bunches. This happens all the time. So if you have a business owner client and they're excited about doing this, ask them if they have any partners. They will be more than happy to let you talk to their partners and take advantage of this as well. So the advantage of doing this for the C corporation owners, they can utilize shorter premium schedules because there's no age-based limits. If you have $100,000 to spend and you do a single premium, you're going to get more insurance than if you stretch it out over 10 years. So the C Corp owner or anybody doing it for an employee, you can use whatever. You can use the short premium schedules and get it over with, and you get all the deductions. The pass-through entities, it's a little different for them. They are subject to age-based limits, but they're not subject to the 7.5% floor itemizing. It's a guaranteed deduction for them. So when they're calling and say, do you have anything for me? Yes, I do. It's a guaranteed deduction. Here's how it works. And they'll be very happy. But there's things to think about as well. So remember the life insurance component. I'm going to go back here for a second. The life insurance component, the first bullet, that is literally ruled by 162. So it's like that part of it's like a 162 plan. And as we know, with a 162 executive bonus plan, you have to meet the reasonable and necessary rule, meaning the life insurance premium has to be a bonus that's reasonable and necessary to the job they perform and the salary they receive. For the owner, that's not going to be a problem. And for any key executives he includes, that's not going to be a problem. But I've had a few cases where they have also included the admins. For the admins, a single premium probably is not going to be a reasonable bonus. And I had a case, they were doing large amounts and the 5 pay was right on the cusp of reasonable. So we did 5 pays for the executives and 10 pays for the 2 admins. And that took care of the reasonable and necessary. Pass-throughs are a little different. So instinctively, we always try to give our client the best value. So if somebody says to the client, well, if you pay with a single premium, you'll get more coverage than if you spread it the same $100,000 out over 10 years. Here's the problem. If you pay with a single premium, remember it's subject to age-based limits. You can't deduct it all like you can for the C corporation owner. And so they would get 1 small deduction. Now, if you spread it out over 10 years, they get 10 deductions. So you want to ask your client, what means more to you, 10 deductions or a little more coverage? 90% of the time, they're going to say 10 deductions. And so they will want to do the 10 pay. Almost every single time, the 10% who say, I'll just go ahead and do a single pay, get a little more money for my premium dollar, and 1 deduction will be fine. Almost every time they're women. Yes, Julie.
So the other day, it came up how a sole proprietor differs.
Yes.
So could you kind of expand on that for the group?
Sure.
Okay.
So there's this lovely little exception in the the tax code. So I'm going to go back to this chart for a second. And this only works for a sole proprietor. So I could have done, if I were still married to the first, I only had 2 husbands, but if I was still married to whenever I say the first husband, I've had people say, well, how many have you had? So
She has to clarify.
I have to clarify that that just 2. So my first husband, he was a sole proprietor and I worked for him. We could have done this. We didn't, but we could have. So if you're a sole proprietor, and again, only sole proprietors can do this, and your spouse works for you, and this is how you get around the age-based limits. Your spouse buys a policy as an employee. You set up that as a spousal plan. Then the owner goes on the spouse's employee's spousal plan, and they get to deduct everything. Only works for sole proprietor. So again, we'll say John and Sue. John owns the company, his wife Sue, and he's a sole proprietor. His wife Sue works for him. He decides to give Sue a bonus of a long-term care policy. Even though it's his wife, it's a sole proprietorship. There's no family attrition rule. She can be treated as an employee. So he's going to bonus her this policy. On top of it, he sets it up as a spousal plan. So he puts a piece of paper in writing his accountant will help him with that piece of paper saying that they have a spousal health plan. And then he joins her plan as a spouse. So he's not buying it as an owner. Therefore, he's not subject to age-based limits. He's become the spouse of an employee's spousal plan. And then they're able to deduct 100% of the premium, not the age-based limits. So again, only sole proprietors can do this. Let me give you my story about the S corporation owner. So I had this case, and he was an S corporation owner, and he wanted to put his wife on there, and she worked for the company. That's where he met her, and she was still worked for the company. And this was a very successful business, and he was worth a lot of money. And this was his second, it might have been his 3rd wife, but whatever. There was a prenup. There was everything, all this paperwork, prenups, wills, trusts, that basically said she would never get a dime of the company. He would leave her other monies, but she was never it was a family-owned business. It was going to his sons. She was never under any circumstance to have any interest in the company. So he thought that was enough to be able to treat her like an employee. And I'm like, no, she's his wife. That's all it takes for family attrition rules to apply. So he still had to treat her as a spouse, and he could only get her deduction to age-based limits. So the spouse thing can work in your advantage or not necessarily so. So that's kind of how the spousal thing works. S corporation, your spouse is your spouse. Whether they work for the company or not, they're treated as a spouse. C corporation, they're not, and the sole proprietor can do. So partnership, it's like the S corporation. So the spouse thing it changes around depending on the situation.
Thank you.
Now, how do we design a policy? I don't know if anybody likes numbers as much as I do, but you can tell from this chart I like numbers, and I hope you can see. I think the people on the Zoom call can see this much easier than the people in the room here today. But what I'm trying to demonstrate is case design. And it's important because it's going to determine how much tax the employee or C corporation owner is going to have to pay. I'm showing 3 examples. All of these are 55-year-old male, non-tobacco couple rate, 6-year benefit CareMatters 2 policy, paying $20,000 a year for 5 years for premium, so a total of $100,000. If we do not put inflation on it, we'll have $208,000 of death benefit. Great, we're not buying life insurance, but it looks pretty good. They're going to have a solid $626,000 of LTC benefits, so that's a nice 6 times leverage. It's the same no matter when you need long-term care. But the life insurance premium on this is going to be $17,000. That means $17,000 is taxable to the employee as a bonus. $3,000 is LTC premium. That will not be taxable to the employee. So the business is going to deduct the whole 20,000, but the employee or C Corp owner will pay tax on $17,000. Now, this is still a good deal because in the end, that really means about $5,100 in taxes. So if you were to say, I'll give you $20 if you hand me a $5 bill, anybody would tag that. It's a great deal. Everybody's happy. But we can do better than that. So if we add 3% compound inflation to this, our death benefit for the same dollar is going to go down. Still, it's $153,000 that the employee wouldn't otherwise have. We're not buying it for life insurance, but still good. And we're going to start out a little lower at $458,000. But because this is inflating at 3% a year, by the time we're age 80, we now have over $1 million, over $13,000 a month for LTC benefits, cash. Better yet, the business still deducting the $20,000 a year for 5 years, but the taxable income that represents to the employee is only $12,400. So now we're at about $3,700 in tax. And the $7,600 of LTC premium, not taxed. And all the benefits are tax deductible. Now notice you see a break-even age here, age 66. What that means is the $458,000 will be worth $626,000 at age 66. That's why we call it the break-even age. In other words, if you put inflation on this for the same dollar that you would have spent for no inflation, how old do you have to be before it reaches the no inflation number? And here it's age 66. So that's a safe bet. So this would be a good deal. And you make it to 80 and you really win big. What if we did 5% compound inflation? Well, now the death benefit is just the return of premium, $100,000. Still, it's the employee's family getting it. He isn't spending $100,000 for the policy, so it's still decent leverage. And his LTC benefit is going to start much lower at $289,000. At age 80, has $1.1 million. So he's at $13,600 instead of $13,025. Literally about 6 months ago, he broke even with the 3% compound. He had to be about 79 and a half years old before the 5% compound wins. And reason I say that is consider, depending on the age, you may want to just stick with 3% compound because you want to be able to have, if they have long-term care situation sooner than later, maybe it happens at 77, they would have had more money on the 3% plan than the 5% plan. And it'll take till age 71 to catch up with the no inflation. But again, there's the $20,000 tax deduction. Yes, Julie.
Hi, sorry. So when you're age 80 with this plan, you'll see the monthly benefit is $13,325 a month.
On 3%.
On 3%. Yeah, right. And then it's even higher on the 5% compound. So of course, devil's advocate, people will say, well, if you don't spend that amount, I guess I'm referring to the HIPAA guidelines, the taxable, this is now going to be taxable as income, and you're going to be an employer and you're going to have to give whoever a W-2, you know what I'm saying?
Well, let's talk about the tax. So I have a paper out there clarifying the myths and misconceptions of long-term care benefit models. And one of the biggest conception is all of these people are going to have to file Form 8853 and pay tax on their benefit. In fact, one company continues to misquote the tax code and claims anything above HIPAA is taxable. That is not true. The way the tax code actually reads is you may receive tax-free the greater of the HIPAA per diem or the actual amount of your long-term care expenditures. If you collect below the HIPAA per diem, it's all tax-free. No matter how you spend it, you don't have to keep any records. It's all tax-free, period. If you collect $9,000 a month and you spend $4,000 a month on care, the rest of that $5,000 is still tax-free, period. End of story. It's only when you exceed the IRS guidelines. So it's not the HIPAA formula, it's the IRS guideline formula. So you could collect 15,000 a month when the HIPAA per diem is 12,300. It's still tax-free if you're spending 15,000 a month on your care. And that's what some of these companies don't tell you. The other thing that nobody tells you is that with long-term care riders on life insurance, 87% of those policies are issued at or below HIPAA at issue date. Now, most of these people won't have a long-term care claim for 20 years. So the 13% that were issued above the HIPAA per diem, a lot of those will be within the HIPAA per diem by the time they go on claim. So this does not, so anyone, the chance of owing tax is slim. With CareMatters, 98% are issued at or below the HIPAA per diem.
So they'll never exceed it, in other words. Well,
Generally, so highly unlikely. If you're issued at or below HIPAA with CareMatters, and even if you put 3% compound inflation, you won't exceed. HIPAA has been averaging 3.2%. So HIPAA will still go up a little higher than your 3% compound. The only people who will run into an issue are the people who buy the maximum benefit, or they buy something right around HIPAA and have 5% compound. And even then, it won't be that much over HIPAA, and their expenses could end up negating any tax situation. The other thing is Form 8853, which other carriers will try to make sound like this horrible tax form that you have to fill out. It takes 5 minutes, literally 5 minutes. I would much rather spend 5 minutes once a year. It's very simple to fill out. I'd spend 5 minutes with that form than I would having to do receipts and bills, sending them in every month. And even if the company will do direct billing, you still have to do your due diligence every month. Make sure you are not accidentally double billed. All of that takes far more time than the 5 minutes it takes to fill out 8853. So people hear IRS tax form and they panic and the cross and the garlic go up. No, it's a 5-minute job. 5 minutes. So it's nothing to worry about at all. So I am going, so I don't know, did anybody else in the room have a question before I move to the sales idea? Or okay.
No.
All right. So I am going to close this out. Or stop share. Okay. As you all know, sunsetting is on the horizon. And what that basically means is if the Republicans win the election, sunset will not happen. That's what they have said anyway. They're not going to let it sunset. If the Democrats win the election, they will allow it to sunset. But one thing that everybody has promised is there will be no clawback. So what I mean by that, what we're looking for right now are clients who have used 7 to 7.5 million-ish of their lifetime gifting exemption. If things sunset, that's about the number it's going to sunset back to, 7 to 7.5 million. Which means right now it's at $13.61 million. That's over $6 million they never got to use of their exemption. But since there's no clawback, if people kind of take this last year and a few months and think of ways to use that exemption, and they can afford to do it, it won't get clawed back if the Democrats win. They've promised that there's going to be no clawback. And there never has been a clawback. So it's a safe venture. So how can we help those clients who are going to have that use it or lose it tax exemption? How can we help them spend it? Well, one way is with long-term care coverage. And you're probably thinking they're high net worth people. Why would they be interested in long-term care? Well, several reasons. So first of all, I'll just give you a case we just did. $600,000 single premium into CareMatters Together. It was not California. So the client invested heavily in real estate. And sometimes he was so illiquid, he could barely pay his bills. Other times he was very flush with money. This happened to be a moment in time when he was very flush with money. And he was talking to his financial advisor and he goes, I'm kind of worried. I'm watching people, parents, aunts, uncles, all, I'm worried about them needing, they need long-term care. And, I can afford to pay for it. The problem is, what if it happens at a time that I'm not flush with cash? I'm going to have a fire sale on some asset. I don't want to do that. And he found out our policy was a cash indemnity policy, meaning he's just going to get a check for cash. So he bought a pile, what he considers he bought a pile of cash. And so we put $600,000 single premium, bought the maximum amount we would sell. And he is thrilled because now he doesn't have to worry if he ever needs long-term care and he's heavily invested and not very flush with money, doesn't matter. He goes on claim and Nationwide is sending him tens of thousands of dollars a month to provide the care he wants. The other thing with wealthy people is they tend to stay at home 24/7. So with the middle class or even mere affluent, we will go to a facility as soon as staying at home becomes more expensive than going to a facility. The high net worth don't do that necessarily. And I have a friend, I know him through the business. He's retired now. He's in his 80s. And his wife, he's been paying for home care for his wife now for 5 years. He has spent well over $1 million. And even though he sold long-term care, I used to go to his office and do he ran a BGA and I'd go to his office but he never bought a policy for him and his wife. And he, oh, I see that look. And he's like, in retrospect, it sounded like, oh, I can afford to pay for this. Now I'm paying for it. And he's a very kind man who donates to charities. He goes, I'm thinking of all the money, the good things I could have done with this money. Instead of spending it on care, if I'd had a policy, this money could have gone to a charity. And he's very sorrowful now that he didn't have a policy. That's the other thing. High net worth don't often think about, yeah, you can afford to pay for it, but what does that mean? It means you're not giving the money to your favorite charities. It could also mean maybe you're losing some of the liquidity. Maybe you're a little uninsured for estate taxes, and that liquidity would have been useful at your death to help pay for the estate taxes. And now maybe your kids have to sell something off they'd rather not sell. So that's just a couple of reasons why the high net worth really need to think about funding long-term care. Yes, you had a question?
You may want to talk about how you can use this in an irrevocable trust because it's indemnity.
Yes.
To reimbursement where with Hancock or someone where
yes.
You can't.
So, and I have white papers on that we can send you. There are 2 of them. The process is the same. It's the case that one case study is CareMatters, one is the LTC rider. But basically, if you have people of high net worth, we can put these in an irrevocable trust. And the beauty of it is well, first of all, let me start with, if you're going to approach your client or their attorney, don't say something like, well, I want to talk to you about long-term care planning for your client. Because first thing they're going to go, what do you mean? We can self-fund. They'll actually call it self-insure, but we can self-fund. That's silly. We don't need to talk about that. The way you want to open is say, I have figured out that our client, if you're talking to the estate planning attorney or to the client, I have found that there's a weak link in your estate plan. That's what I have to do. I have found there's a weak link in your estate plan. And they're like, what do you mean there's a weak link? I thought you had that taken care of. He goes, well, everyone thinks they have it taken care of, but I have figured out something that most people haven't figured out. You plan to self-fund your long-term care, correct? I'm like, oh yeah, I can afford to do that. That's what I'm going to do. Well, here's the problem. So you leave all this money in your estate to be able to pay for home care for several years, and you're lucky enough to die in your sleep. What's going to happen? And if the client's real smart, he'll say, pay estate tax on that money. Exactly. My job is to help you pay as little in estate taxes, your estate to pay as little in estate taxes as possible. So I have a way of using long-term care coverage inside an irrevocable life insurance policy that will not only spare you unnecessary estate taxes if you're lucky enough to need long-term care, but if you do need long-term care, it's going to make money for the trust. Now you see what I mean by win-win. There's no lose. It's either good, better, or best outcome. There is no loss. And so these papers will go into exactly how you do it. Just briefly, the trustee can't just hand them the money. They borrow the money. Collateralized arm's length loans, there's an interest rate you pay. We don't use low interest. We use as high of interest as we can get away with, which is usually 7-8%. It could get, if interest rates were to keep going up, we could go higher. Under the current environment, it's still about 7 or 8%. And what you're doing is creating a debt on purpose that has to be repaid. Well, who's it repaid by? The estate. So the estate puts all the money of interest that's built up into the trust tax-free. We've made more money for the trust and so on and so forth. Anyway, it takes a while to go through it. The CareMatters case study, if you were to use your close to all of your CareMatters policy, the net cost of your policy would be nothing. Nothing. Because the estate tax savings would pay for the policy. So when the attorneys see this and the client and they understand, my white papers are, by the way, they are client approved. So the attorney and even the client can see it. When people have that much money, they want to understand what they're doing. I made sure they were client approved. So you can show them to the attorney and the client. Thank you for
So you're
asking.
basically describing an island with just a demand loan provision for the grantor of the trust.
Yep. And there's, I have estate plan documents. The truth is the lawyer already has the same template. He just doesn't know that's what you use. And you choose, so, on the one document, there's 3 different ways they can ask for the loan to be repaid. You just pick the one that matches my white paper. It's that easy. So actually, the attorney doesn't realize he already knows how to do it.
To me, it's 15 years ago, 20 years ago, the conversation with hybrid LTC money guard was you had a stagnant asset, CD, whatever, earning no interest. You're just repositioning that, creating all this additional leverage for tax-free long-term care.
Mm-hmm.
This conversation is similar in that you have stagnant assets just sitting there that we're repositioning, creating leverage. But in addition to the leverage of the tax-free LTC is getting the money out of the estate, what you saved in estate taxes, et cetera. So
And
it's just-
increasing the value of the trust. Right, exactly. So like I said, there's no losing situation. It's just a matter of how big you win. My example, in my white papers, I will show you if they die and never need long-term care, and if they die as the last payment is made. Most people will be in between, but you're going to see the low end and the high end, and just realize that most people will be somewhere in between. So I want to just show you now, let's look at our case examples here for the high net worth. Buying this on their adult children. So they want to use up some of that tax exemption that they're going to lose. And they realize that this is important. So they have a son and a daughter. They're going to do a $250,000 single premium, 6-year benefit, 3% compound inflation. For the daughter, if she never uses the policy, there'll be a death benefit that she can leave to the kids or whoever, her spouse, of $32,000. At age 80, she will have $3.9 million in LTC benefits, paying over $50,000 a month. This will pay for any type of alternative care, whatever it is she wants. Keep her in her home to the day she dies. This is going to be a lot of money. And for the son, it does even a little bit better. He's going to have a slightly larger death benefit of $487,000. And at age 80, he'll have $4.1 million, almost $54,000 a month. And they've just used $500,000 of that tax exemption they're gonna lose if this sunsets. What if they like their in-laws? They like the daughter-in-law, they like the son-in-law. They can buy them policies too, and now we have $1 million we've used up. Or if it's not in California, you could do CareMatters together for the couples and maybe put 500 grand into each couple's policy. Now, let's look at the second case study. And we run across this where you've got someone who's made it on their own. They came from a poor family. Mom worked 3 jobs to help pay for college. They got scholarships. They've managed to get through. Maybe they're a neurosurgeon or whatever. They're, they've made it very big. They have a lot of money. They're definitely a high net worth person, but their parents still are not. And they realize if their parents need long-term care, they do not want their parents in a Medicaid facility. They want them to receive good care. So they're going to give their parents a policy. In this case, I went ahead and just used CareMatters together. Again, you could do 2 CareMatters 2 policies, whatever you want to do, but I show using a $500,000 single premium to purchase $1.7 million in a shared benefit pool, paying $18,000 a month each, 96 payments, and a death benefit that's more than what they put into the policy. So this is something that the high net worth adult child could do for parents who are not of well means, so they don't end up going on the adult child's payroll for long-term care. So you have a lot of opportunities here, a lot of reasons why the high net worth actually do need long-term care coverage, not because they can't afford to pay for it, but it doesn't make sense for them to pay for it out of pocket for various reasons. And so I hope that you can use this idea in the next few months, help them realize they can use up some of the last of that tax exemption money they could possibly lose depending how the election turns out. So what questions do you have?
Any news on the state mandate?
The state mandates?
I can't talk anymore. The updated state mandate here in California, are we gonna see that anytime soon?
Not anytime soon. So basically the date to propose legislation passed on February 16th. So they cannot propose legislation this year. Ironically, as excited as some of the legislators were about all of this, they were excited until they found out it was a mandatory tax. A lot of them, believe it or not, thought it was going to be a voluntary program. They found out it wasn't. It's an election year. They lost interest fast because they realized they might not get reelected if they push another tax. There's no champion right now to pick it up in 2025. That could change as soon as the election is over. Nothing's going to happen until 2025. What a lot of people don't realize is the task force has been dissolved. It doesn't even exist anymore. So there was it's Bill 1264, something like that. Part of that bill, it extended the task force's period of activity, but it also would dissolved it as of July 1st of 2024. So it doesn't even exist anymore. So at this point, what they need a senator, state senator, or assembly person to want to become a champion and garner up interest in this. The programs have all been assessed by Oliver Wyman. They've got the report. They know what it's going to cost. They know how the structures should work. That report is not statutory. They don't have to follow it. They could turn around and just say, oh, we don't understand any of this. We'll just do what Washington did. It'd be silly if they did it, but a lot of people think they're bound to that report. They're not. So we'll have to wait and see after the election is over if someone decides to take it up and champion, bring it, excuse me, back into the conversation. Do any of you do New York, work in New York? Don't do that when I'm drinking water. Well, just so an update, the New York bill is still on the docket. It will not pass. They're out of session for the rest of the year, but state senator and mayor will almost positively bring it up again next year. Problem is, the only thing they recognize for the opt-out is traditional long-term care insurance. So I'm on a lobbying committee with Fonseca. We're working to get Senator Mayer to possibly try to expand the definition of long-term care, if nothing else, for the opt-out. If your New York clients absolutely don't want a traditional policy, the linked benefit policies have the best chance of maybe getting an exception because they're a long-term care purposed policy. They're not life insurance. New York does not recognize acceleration of death benefits as long-term care, even though the federal government does. New York says, yeah, we don't care. We don't recognize it. That's the problem. So that's a little bit on New York. Washington has a bill on the November ballot, Initiative 2124, that bill is to allow people to opt out of the Washington Cares Fund for no other reason than they don't want to pay the tax. If that bill passes, there will be a tsunami of people swarming the Employment Security Department asking for their opt-out certificates that they can take to the employer and say, don't take any more tax out, I'm done. And the reason they did this is there was a conservative activist who realized there was no way to repeal the program. The Democrats have a stronghold in Washington. There was no way to repeal it. So the only way to get rid of it was to defund it. And how do you defund it? You make it optional. Enough people decide they don't want it, there's not enough money to keep it going. Washington state has the choice of proposing their own initiative. So you could say, I want this one or this one, or they can keep it a yes, no, and then put out a huge vote no campaign. And AARP and the SIU union, both who will lose tens of millions of dollars, hundreds of millions of dollars, if this bill is to be repealed or defunded and gotten rid of, they're funding the vote no campaign for the state. So right now, my contacts are telling me it's right at 50-50 whether it will pass or not, 21-24. So we'll wait and see. People are asking me what are other states going to do? And up until that initiative, I said they're going to wait and see what California does, because if California, who did a much better job of organizing this than Washington did, if California puts together a decent plan, other states will just copy California. But now we have that new iron in the fire with Washington trying to repeal or defund it. So we'll wait and see what happens in Washington. And then we'll see how other states decide whether they should just forget the whole thing. So we have a little bit of wait and we'll find out what direction other states are going to go.
And my last question, or one of my last questions that I get all the time. When is CareMatters Together coming to California?
Oh, good Lord. Who knows? I've determined that California is worse than New York at this point. I mean, it's for different reasons. New York has all of these regulations, half of which don't even make sense. And then California just, you give them a quick response, but they don't give you a quick response. They ask you questions like within the week, we've sent the response back to them, and then we wait 6 months before we hear from them again. I just think California doesn't have enough people to handle everything. And the other issue is that California is a state where there's a separate health department versus life department. The life doesn't understand the health doesn't understand the life, and that also delays things. So who knows?
Yeah.
Let me see. It looks like there's chat here. I'm going to try to.
Oh, international claims. Sorry, did we touch on international claims?
We did not.
Okay.
Okay, so,
I mean, me as the wholesaler out here in the field all the time, I swear to God, and I say this all the time, if I had a nickel every time somebody asked me about our international benefits, I mean, I'd be like in Tahiti right now. But I wanna know, how do we stack up? Because I get that question a lot. How do you guys, I mean, we have a lot of people from other countries that live here that potentially wanna go retire in their home country. And they asked me, I have a guy in San Diego, he's from Turkey, he's Greek and Turkish, and he's like, I'm gonna retire in one of those. How does your international work? So could you briefly explain how international works with us and how we could design it to make it as beneficial to
Yeah.
those types of clients?
yes, so, there's
And
one,
what it means to qualify,
Right.
sorry, how do you qualify? You
Right.
don't just need a US doctor, there's
Right, I'm
other
gonna-
ways, okay. sorry.
okay.
I
So
understand.
there's a company out there that claim they don't require your doctor to be US licensed. I'm not gonna say who it is, but my answer is always is read their contract. Read their contract. In the contract, it specifically says the doctor has to be a US licensed healthcare practitioner. Because it's a regulatory requirement. But there are ways around it that are legal, and we do that as well. So what we do is we have a third-party administrator. That they will, so your client, let's say your client's going back to Turkey, and they've already gone there. And at this point, they go to a Turkish doctor, and the medical records are all written in the Turkish language.
Right.
So what will happen is if they go on, they file their claim, they turn in all the basic paperwork. We're gonna ask for the medical records. We want it to come over in the original language, so they would send the Turkish records to us. We will have them medically translated. If the records are enough to verify the claim, done. And then our third-party administrator is going to write the plan of care, which is another regulatory requirement. We will write it here for them based on the medical records. So now this third-party administrator has reviewed the records and has determined this is a legitimate claim. And that third party is also writing the plan of care. So think of it as we are assigning a third-party US licensed healthcare practitioner as a partner to the foreign doctor. So you're still able to use your foreign doctor's records, but it's our people who we've partnered you with that will actually be assessing them, writing the plan of care. And so we have complied with US regulation. Now, what if the records aren't enough? Then we will do a video conference with them, try to do a video assessment. If that isn't enough, then they would have to find a US licensed healthcare practitioner who could do an in-person assessment. So how do they find one of those? Well, the first place you go is Google. And it depends what country it is. Years ago, I went on Google and in 5 minutes found a giant list of US licensed healthcare practitioners in Japan, but I couldn't find them for England. So how odd is that? There's several ways to do it. The other way is you can call the American Medical Association. They often will have a list, because remember, if you're still licensed, you're still part of the AMA, and they can provide you a list of doctors. Another thing that you can do is go to the US Embassy and ask for a list of doctors. The US Embassy, there's a misconception that you can go to the US Embassy for a doctor's appointment. You have no idea how many people think, no, you can't go there to go to the doctor. But you can go there and ask for how many doctors in the area and get their contacts. The one thing you can't do is go to a US military base, which is the other thing people think you can do, unless you're in the military. So if you're stationed overseas and the wife, who also has a policy, for example, has a long-term care event, she can go to the base because she has access to military health care. But the average citizen, no, cannot go to the US base. So yes, that people believe that. Yes, you had a question.
Do you have any idea how many claims Nationwide has paid internationally?
We don't divulge claims information, but I will tell you one thing. So if none of this works, that's only then does the client have to come back to the US to be assessed by a US licensed self-care practitioner. That has happened one time.
There was another carrier that said that no international claim has ever been filed.
Oh, no, we've had. There, I will tell you this. Everyone thinks they want to go back to their home country. They don't go.
Yeah.
They don't go. So there's not that many.
Not that, yeah.
But that's why. It sounds good on paper. They come here from China or wherever and they think they're gonna go home when they retire. But after visiting over the years, they realize, I think it's better where we are, and they don't go.
Mhm.
So it's a nice to have, but they don't do it. Now, what if you have a client who is absolutely convinced they're going back? What do you sell them? Because that's important. Our long-term care rider pays 100% benefits. So if they need life insurance, it's a good solution. Add the long-term care rider. They will have access to 100% of the benefits, the same access they would have here in the United States. With CareMatters, however, they only have access to the first bucket. So the first bucket pays 2 years. In New York, you can choose the 3-year bucket. And we will give them all the money, but only for the first 2 years. To get the rest of it, they would have to come back. But they like the idea of CareMatters. So what do you sell them? You sell them short and rich. 2-year bucket, 5% compound interest. It shoots up really fast. They're getting a cash benefit. They're getting all of it. They can take what they don't need for their care and bank it, invest it for the future years when their 2 years is up.
They can be used for home care or anything. It doesn't have to be a facility.
Right. Yeah, our benefits are cash, whether domestically or the other question I get, believe it or not, is the number one question I get is Puerto Rico a foreign claim? That's the number one foreign question I get. No, it's a domestic claim. Puerto Rico is a territory of the United States. So if you live in the 50 states, Washington, D.C., which is a district, U.S. Virgin Islands, not British, but U.S. Virgin Islands, Puerto Rico, Guam, Northern Mariana Islands, some American Samoa. There's 8 other islands. They're all only U.S. military bases, so I don't list them. That's all the United States, all of it. That is a domestic claim. It's only when you live outside of the US, its states, territories, and possessions, is it a foreign claim, right? And if you have to come back, let's say you're in Japan and you have to come back, you just have to get to Guam to see a doctor. You don't have to come all the way back to California. Just get to Guam, a lot closer. So,
Shawn Britt, familiar with where the ID is.
And you made the point earlier of the bank being like we have Cafe Bank and Bank of Scotland.
yeah, oh, I didn't mention that on this
Yeah,
call. So how do you get your money? We are only allowed to pay in US dollar. We cannot mail checks to foreign countries. In fact, today we issue very few checks. Everyone with just electronic banking into your account. If you're overseas, it's the only way we will do it. Let's say you live in Beijing and you go downtown to the financial district and you look around and look for the US banks. Bank of America, Citibank, Chase Bank, look for the US-based banks. You open an account there. Then we will put your money in a 9-digit routing number. We'll put your money in that bank. So let's say you choose Bank of America. We put the money in the Bank of America account. You go to Bank of America and then ask for your money in Chinese currency. And then that's how they give it to you. So it's paid in US currency, but you can have it then
And
turned in.
oftentimes, you know, these policyholders who purchase the policy here and maybe now retire over there, they have established banking relationships here, right? So,
Yes.
yeah, you have it electronically transferred, you can access the cash.
Right, most people don't just go to the foreign country and just shut everything down
Exactly.
here, because they have family here. And so it's just as long, it has to be a US bank with a 9-digit routing number.
Yeah, you can use an ATM machine that, like a Chase Bank, it works.
Uh-huh,
Yeah.
yep.
I think that's time. We'll wrap it up here.
Well, thank you all so very much for joining us. Thank you, everybody on the Zoom call. We appreciate you coming to see us today.
Thank you, Shawn.